Something is moving beneath the surface of the Middle East that the financial press is not connecting to your portfolio. Not the headlines you are already reading, not the drone strikes, not the shipping disruptions, not the oil price fluctuations that dominate every panel discussion on every financial network. Something quieter and far more consequential for anyone holding or considering silver. The kind of structural shift that does not announce itself with a press release, but reveals itself slowly, then suddenly, in the behavior of the people who actually move markets. I want you to hold that thought for a moment, because what I am about to walk you through is not a prediction dressed up as analysis. It is a forensic reconstruction of a causal chain that is already in motion, already producing measurable effects in physical silver markets, and already being ignored by the institutions whose job it is to pay attention. Let us begin where serious analysis always begins, not with prices, with systems. The Middle East is not simply a geography of conflict. It is the intersection of three critical supply chains that silver depends upon, and two financial architectures that silver pricing depends upon. When those intersections come under simultaneous stress, the effects do not travel in a straight line from cause to effect. They compound. They amplify. And by the time the mainstream narrative has assembled a coherent explanation, the price has already moved. Here is what the numbers actually show. Silver's all-time high sits at approximately $49.51 per ounce, set in April of 2011. In January of 2026, silver touched $121 before pulling back. And yet the financial press continues to frame every silver move as a safe haven reaction, a dollar story, a geopolitical sentiment trade. These explanations are not wrong. They are dangerously incomplete. Because what the Middle East crisis is doing to silver is not primarily a sentiment story. It is a supply chain story. It is a refining story. It is a strategic reclassification story. And it is a story about what happens when the world's most industrially critical monetary metal gets caught between collapsing Western refining infrastructure, Chinese export restrictions, and a regional conflict that is simultaneously disrupting shipping corridors, defense procurement cycles, and the energy transition build-out that now consumes more silver annually than any other single application in history. Welcome to SilverDispatch. I am OG Peter. And what I am going to show you today is why the Middle East crisis is not a temporary headwind for silver. It is the event that forces the reckoning the physical market has been building toward for 5 consecutive years. Stay with me. There are 3 structural forces the Middle East crisis has activated simultaneously, and understanding each of them separately is far less important than understanding how they interact with each other. Because this is not a story of 3 separate problems. It is a story of 3 pressure systems converging on a single point of failure. The first force is the Strait of Hormuz choke point and what it means for silver's industrial supply chain specifically. Approximately 21 million barrels of oil pass through the strait daily. That number gets quoted constantly. What gets quoted far less frequently is that the same shipping corridor carries refined silver, silver ore concentrates, and the industrial chemicals used in silver refining operations. When that corridor comes under threat, the disruption does not merely slow delivery timelines. It forces buyers to reroute, to pay emergency freight premiums, and in several documented cases from late 2025, to cancel procurement contracts entirely because the economics of rerouting exceeded their operating margins. The second force is defense procurement. And this is the mechanism that most analysts have systematically underweighted. Every modern missile guidance system, every radar array, every electronic warfare platform deployed by every party operating in the Middle East theater runs on silver-dependent components. Silver is not substitutable in these applications on any timeline shorter than a decade. When regional conflict escalates, defense ministries do not reduce silver procurement. They accelerate it. United States defense contractors consumed an estimated 37 million ounces of silver in 2025, a figure that grew 14% year over year as procurement chains were stressed by regional conflict requirements. The third force is what the Middle East crisis is doing to the energy transition timeline and why that matters specifically for silver demand. The geopolitical instability driving oil price volatility is simultaneously accelerating the political urgency behind solar deployment across Europe and North America. Every spike in oil prices produces a new legislative push for domestic solar manufacturing. Every domestic solar manufacturing push increases silver demand. Solar applications already consumed more than 25% of global annual silver supply in 2024. That percentage is rising as installation capacity expands faster than mining and refining output can follow. These three forces do not operate independently. Defense procurement competes with industrial manufacturing for the same deliverable physical silver pool. Shipping disruptions slow the same supply chain that solar manufacturers depend upon. Energy transition urgency drives political decisions that accelerate the very demand that is already outpacing supply. Here at SilverDispatch, we track these structural intersections precisely because the paper price rarely reflects them until after the move has already happened. If this structural forensics is the kind of analysis you want delivered directly to you before the mainstream catches up, subscribe now. Because what follows is where this story gets significantly more specific. The conventional resolution narrative deserves a direct and unflinching examination, because it is wrong in ways that are going to cost people real money if they accept it uncritically. The mainstream argument holds the following position. The Middle East crisis is a temporary geopolitical premium. Silver has run up sharply on safe haven flows. Regional tensions will de-escalate, as they historically have. The premium will compress. Silver will retrace toward its industrial price floor. Sophisticated investors reduce exposure here, rather than adding it. That argument fails on four specific and measurable grounds. First, this is not a sentiment premium sitting on top of a stable underlying price. The underlying physical market was already in structural deficit before the first escalation headline in this cycle. The Silver Institute has documented 6 consecutive years of consumption exceeding production. The cumulative deficit exceeds 800 million ounces. A geopolitical premium does not sit on top of that deficit. It compounds it. When the sentiment premium eventually fades, it does not return silver to where it was before the crisis. It returns silver to a physical market that is 800 million ounces shorter than it was in 2020. Second, the de-escalation assumption ignores the structural changes that regional conflict has already permanently triggered. China's silver export restrictions, implemented January 1, 2026, were not announced as a response to any single geopolitical event. They reflect a strategic reclassification decision made by an institution that does not reverse strategic reclassifications for market convenience. Mexico's movement toward raw silver export limitations reflects the same logic. These are not temporary measures. They are structural reconfigurations of the global silver supply chain, and they will not unwind when a ceasefire gets announced. Third, the substitution argument, that manufacturers will simply replace silver in applications where it has become too expensive, ignores qualification timelines. Aerospace, defense, semiconductor, and medical device applications require 2 to 4 years minimum to qualify alternative materials. The Middle East crisis is compressing demand and constraining supply in a window where substitution is physically impossible at the rate required. Fourth, and this is the point that matters most for anyone thinking about where the all-time high sits relative to current prices. The 2011 all-time high of $49.51 was set in a world where COMEX registered inventory coverage was above 60%, where Chinese refining capacity was fully accessible to Western buyers, where solar was a rounding error in the demand picture, and where the cumulative physical deficit was zero. The world that set that all-time high no longer exists. The structural conditions that exist in 2026 are not comparable to 2011. They are meaningfully more constrained on every dimension that drives price. The all-time high is not a ceiling in this environment. It is a milestone on the way to wherever the physical market actually clears. Here is the question that deserves your full attention before we close. What exactly is the paper price of silver measuring right now? Because I want you to think carefully about what you are actually looking at when you pull up a silver quote on any given morning. You are looking at a number produced by a derivatives market, a futures market, a system designed to price a commodity assuming a functioning global delivery pipeline, a stable refining network, accessible Chinese capacity, and physical inventory buffers deep enough to absorb supply shocks without systemic strain. Every one of those assumptions has been violated in the past 6 months. COMEX registered silver inventories, the metal actually available for immediate delivery against futures contracts, fell from approximately 346 million ounces in 2020 to approximately 76 million ounces in early 2026. The coverage ratio now sits at approximately 13.4%. Exchange analysts have historically flagged below 15% as stress territory. In January of 2026, 33.45 million ounces were withdrawn from COMEX registered inventory in a single week. 26% of the entire deliverable pool gone in 7 days. Silver simultaneously entered sustained backwardation, with spot prices trading above futures prices, beginning in October of 2025 and holding through the present. Backwardation is not a chart pattern. It is the price system communicating, in the clearest language available to it, that nobody with physical silver believes the forward supply chain will deliver reliably. The Middle East crisis did not create this situation, but it has become the event that is forcing the reckoning that was already structurally inevitable. Every escalation in the region tightens the same supply chains that were already compromised. Every defense procurement acceleration draws from the same physical pool that solar manufacturers, EV producers, and semiconductor fabs are simultaneously drawing from. Every disruption to Hormuz shipping adds friction to a pipeline that was already running at insufficient throughput. What institutional participants whose behavior actually moves markets are doing right now is not speculating on a geopolitical premium. They are acquiring physical silver at whatever price the paper market is willing to sell it at, before the gap between what the paper says and what the physical market reflects becomes too wide to ignore. That gap is the most significant data point in this entire analysis, and it is the one receiving the least attention from the people whose business it is to pay attention. This is OG Peter at SilverDispatch. We do not chase headlines here. We track structure, follow physical flows, and stay ahead of the narrative before it becomes consensus. If today's breakdown gave you a framework you can actually use, subscribe. Share this with one person who needs to hear it. And tell me in the comments, is silver heading back to all-time highs, or does the paper market still have the power to suppress the physical reality? This content is for education and discussion only, not personal financial advice. Always conduct your own research and make decisions based on your own risk tolerance.